Hey everyone, I'm Jeremy Szafron. This is Kitco News. Don't forget to hit that subscribe button for the latest updates. Well, the U.S. dollar has been on quite the roller coaster recently, with the dollar index at around 104.5, reacting, of course, to President Biden's ending of his re-election campaign. Now, this move has added new layers of uncertainty to the financial markets, and we're also seeing trouble with sovereign debt. Now, high global interest rates are making it harder for some countries to manage their debt levels, including the U.S. And our next guest, our audience knows really well. Tavi Costa, he's a partner and macro strategist at Crescat Capital, and he's bearish on the dollar. Of course, we got a lot of challenges here to talk about here. Tavi, welcome back. Thanks for joining us today.
Thanks for having me, Jeremy. Looking forward to this.
Yeah, me too. I mean, what a couple of weeks it's been. You and I were just chatting briefly before the break. I mean, we have a lot of political news. We have a lot of uncertainty going around in the U.S. political sphere, of course. Globally, we have conflicts. And you recently outlined this bearish view on the U.S. dollar. I mean, as I mentioned, we got a projected increase in the federal budget deficit by $1.8 trillion next year. We got raising debt levels. Of course, there's concerns about the long-term fiscal sustainability. Talk to me about your main outlook and what's driving it here.
Yeah, well, I've been trying to write a letter, and all these issues happening politically have been making it very difficult to focus on this. But, I remember back in 2020 when I saw all these stimulus packages and all sorts of response from policymakers given the pandemic, and learning really from history from what happened during the 1919 Spanish flu and how that actually created inflation. And I was really deep into that inflation thesis. And then, back in 2021, if folks that follow my work would know that I was really deep as well into the issuances of treasuries and how that would cause interest rates to rise. And those are all domino fallings. They started with inflation, and then the response of the Fed, and then the issuances of the debt created interest rates to increase, the collapse of sovereign debt. And it begs the question, what's next? I actually, this is not coming from a political view or even an extreme, which I do think it's a possibility, but not an extreme view necessarily that the dollar is going to lose the reserve currency status or anything along those lines, but really a macro trade for the next 3 to 5 years that I think the dollar will depreciate substantially, not only relative to real assets, but this time relative to other fiat currencies. And the main reason for this, it has to do mostly with the fact of where interest rates are in the U.S. in terms of the interest payment, the cost to service the debt relative to GDP, which is at around close to 4% now. And when we looked at that across the globe, it is clearly well above, almost 2 percentage points other economies. I'll give you an example. Japan. Japan is an economy that is heavily indebted, arguably the most developed economy in the world. And if we look at how much they spend of interest payments relative to GDP, it's actually 0.5%. So we're probably going to have to reinstate financial repression, suppression of interest rates is probably going to be the case. And it's sort of interesting because everyone is, and the Fed is so this obsession with labor markets and inflation coming from policymakers, it's going to have to be transitioned, in my view, into the suppression of interest rates in order to allow the government to pay its bills. And so this to me is ultimately, because currencies are a relative game, is not just what the U.S. does, but it's the U.S. relative to other places. The fact that other places have not been able to raise interest rates as much as the U.S., given the fact that it's the reserve currency and other things, that adjustment to go back to those levels where the rest of the world is in terms of interest payments to GDP is going to have, in my view, a very, very drastic change in the valuation of the dollar, which is likely to depreciate from here relative to other currencies.
Right. So you're talking about a little bit of a cyclical event as opposed to a long-term play. Talk to me about the timing. What did you mention? 2-3 years? I mean, how long is this kind of trade that you're talking about?
Well, this could turn into a much bigger thing. And I do think that there is a very high probability of that happening. But as a macro trader, you're just looking at, a year or two ahead, and you've seen different types of instruments on how to express that view in the markets today. And clearly things are completely mispriced when it comes to that as an opportunity. And so those are the things that I'm paying attention to. You can have a view about the end of the dollar and all sorts of things. but those are very difficult to actually put a trade on, for the next 1 to 2 or 3 years. And so this is sort of irrespective of which party would be in place, which president would be in place, and so forth. It's a single largest issue that the America is really facing. I mean, America basically has what I call a U.S. fiscal exceptionalism, and it's not really because of the economy itself, but it has had a huge impact on the growth of the U.S. versus the rest of the world. So given the fact that we have the reserve currency status here in the U.S., it allows the U.S. to be less disciplinary than other countries. But not for long. It's going to have to come back here. And that, since the global financial crisis, if you look at the average fiscal deficit the U.S. has run relative to any other economy in the world, it's been way larger. And therefore, that is actually translating into growth and inflows of capital into the U.S., which also cause, the equity markets and all sorts of things. And so when you start putting that idea into, well, if we do see a change of that, in the near future, where the dollar actually starts to having outflows, what does that do to all sorts of asset classes that depend so much on those inflows today? And so those are also very important risk questions for any portfolio manager, and that's certainly something I'm very looking really deep into. What are those ramifications of those issues? Because I remember looking at interest rates, and I remember seeing, this caused interest rates to rise substantially. And everyone and their mother was basically disagreeing with that idea, because saying that the U.S. would not allow interest rates to rise. And here we are. And the same people that thought about that now don't think that the interest rates are going to drop. I actually think that's that's the beauty of how narratives change. But the main impact is going to be in the dollar, in my view. And so that's why my focus is on that.
Yeah, interesting. I mean, inflation's been a persistent issue. Obviously, the Fed is sitting here maintaining 5.25%, 5.5%, trying to manage this price stability. But we've been seeing these cracks, Tavi. I mean, we've been seeing this data being revised and coming back and being revised. I mean, we started the year by pricing in 6, 7 cuts. I mean, I think the market's currently at around 1. Some analysts thinking, okay, they need to be more aggressive here, maybe do 2. Some analysts saying maybe do 3. What's your take? What do central banks need to do?
I think it's going to be multiple rate cuts. And the reason for that is because 3 rate cuts would reduce the debt payment by about almost 1/3. And so that basically doesn't solve the issue, but certainly put us in a better position. We have to think about, I mean, historically, how have we done to deal with such a problem? Can the U.S. Carry more debt relative to its GDP over time? The answer is yes, by the way. If you looked at, throughout history, the British Empire back in the 19th century, it actually carried over 200% of debt to GDP. Japan did that not too long ago, but I prefer using the British Empire because it was, the reserve currency at the time. And so, not being the reserve currency changes the way you can politically act towards your monetary system. And so the idea here is that there's really a few things you could do. One is you can restructure your debt, which was what the British Empire did back in those days. They basically increased the length of their debt and so forth, and had to create measures to bring back liquidity into their treasury market, in which, by the way, was the most liquid instrument of the time. Does that sound familiar with the U.S. Treasuries today? The second thing they did was austerity, which sounds very simple. It's basically reducing, the excessive spending in the government and trying to increase taxes. That could come here, but I'm not really seeing this given the AI revolution and what's happening with electrification and onshoring, deglobalization. I wouldn't put too much weight there. I do think we're going to get there, but I don't think I would put too much weight on that situation. But the third thing that economies have done in the past is the suppression of yields in order to reduce the cost to service the debt. I think that's highly likely in the next 2 to 3 years. And if we see that, that probably will have to be a readjustment of the dollar. Pay attention to the fact that we've seen one of the tightest policies of the Federal Reserve in history here in terms of how much they were able to hike rates in the short term. And the dollar is not taking off, right? I mean, the dollar has been actually, if you looked at other currencies, we can see a combination of currencies trying to form a bottom here, a historical bottom, and hitting a resistance, and potentially when they break out, like the British pound did recently, these things can start moving on the upside in a very big way. And that's what unleashes a lot of other macro trends, in my opinion, that I'm paying close attention to. I'm happy to discuss that. But that's really the key of the markets, is where the dollar will go right now. And I think that it's going to go a lot lower.
Yeah, I mean, you got this bearish outlook on the dollar. So then let's talk about commodity prices, especially gold and silver. I mean, what's the influence here? What's your take? What's going to happen if this thesis of yours becomes reality?
Yeah, well, first of all, the gold market and other metals have started to move for somewhat different reasons, but also connected. Number one, gold accumulation by central banks. Well, that's another domino that kind of fell, that a lot of people thought was impossible to happen again. And here we are, one of the largest accumulations of the metal that we've seen in history. But really, all these things are happening right in front of us. And I think that the gold market is the next leg up for gold prices, and silver and copper and so forth is going to come on the back of a depreciation of the dollar. We've seen this historically. I mean, usually when the dollar tends to depreciate versus other fiat currencies, it sort of unleashes other ideas. Like natural resource companies tend to do very well. We see emerging markets doing very well. And economies that have a very strong link with commodities tend to do also very well. And so it wouldn't surprise me if we see another major leg up in gold prices, along with silver and other metals and copper and so forth, on the back of these trades. So that's why my main focus here has been on this, because I do think there's lots of ramifications, and a lot of times in trading and in macro, the big opportunity is not in the main asset class. It's in the sort of the knock-on effects that you see, and maybe mining and other things that have been completely being pushed out as not being, from being opportunities one day to now being completely neglected, could potentially reemerge to be big winners. And so that's where I also have been trying to deploy most of the capital here at Crescat and personally as well.
Okay, well, that's what I kind of want to talk to you about. I mean, with gold future prices recently hitting that new all-time high, it seemed like we had those few months at the beginning of the year where we were so excited, all-time highs, all-time highs. It's not as much in the narrative anymore. I mean, we saw a little bit of a sell-off or a correction. You talked about the miners. We're going to start seeing quarter numbers coming out that could be interesting on the earnings side. So how do investors position themselves in the gold market to capitalize on what you're talking about here with what's happening with the dollar?
Well, the investors will do this depending on the risk profile, but in my view, the big alpha opportunity here is definitely on the mining side. And main reason is because how inefficient the market has been, and how things have been so mispriced historically, and our views about where electrification and the needs for more infrastructure developments is actually going to drive a major side of the demand, and the infrastructure needed for that is also going to be a big side of it. I do think that mining is going to become again a critical part of the economy. We look back in history, back in the 60s or so, when you see the fixed investments that were made by private companies in the mining industry, used to be accounted by about close to 20% of GDP, and today is 0.3%. I think that those measurements are likely to change. The main reason for this change has been mostly because of how much the U.S. has been actually dependent on importing metals in a large way. And I think that, given what's happening with the escalation of geopolitical risks and all sorts of things going on, I do think that metals mining as an industry will come back as a critical part of the economy in the nations. And that's likely to increase the investments in that part of the industry. And so, ultimately that money flows into the different parts of the mining industry that have been for a long time ignored. And the skepticism of this, what I call one of the most historically unsupported views, that we're likely to see gold prices rising, but not the miners won't follow. That's just not what happens throughout history. Usually when you have a gold bull market, the miners will follow along the way. And I don't think this time is different. And most of the people saying this, have zero historical base to really, support that view on.
Yeah, what is the runway here? I mean, how long does that typically take? We know that monetary policy, the Fed starts to give people checks. That shows up in the economy maybe 3-4 years later. We've been talking about this, metal price catching up to the equity side for quite a while. You're still obviously thinking the commodity market is at a turning point here. So what are we looking at?
I had a good tweet recently. I think it was a good tweet. I guess I'm biased, but related to the technicals, just your question about momentum, and I was looking at all sorts of different things. The GDX, the GDXJ, and you can see clearly that all these instruments are starting to break out. You can look at the gold to silver ratio break down, which is usual. You tend to see silver leading the way on the upside. And, it made me think about a period that was one of the most brutal periods for the mining industry, which was basically after the 1970s. We saw the 80s and the 90s was a very difficult period for those investors in the space. We saw gold basically go down 70%. Think about that. Gold was down 70% from its peak levels. And imagine trying to support that opinion about precious metals. No kidding, it was called all sorts of things, a pet rock and all sorts of names. And, in 2001, April of 2001, basically with the gold prices started to really turn around. I keep thinking to myself, imagine trying to defend that view back in those days. And it actually marked the beginning of one of the most important bull markets in the gold history, which has been still the case now. Now, if you look into the mining industry relative to gold prices, the chart is exactly the same. 20 years of underperformance. Now, imagine trying to create a view and support a macro thesis to invest in the mining industry. It is precisely the same idea. And so to me, when I looked at these things, the mining industry is complex, it's difficult, it tends to bleed a lot of capital during bad times. But during good times, it does offer a lot of leverage, and investors have forgotten that for many reasons. And I think that the fact that the industry has underperformed for so long, it's sort of needed that clean sea environment. And now that we're seeing some new firms and new discoveries and all sorts of things, the excitement is slowly coming back. In other words, the negative news that actually are very normal in this industry are starting to be less and less penalized, and you can see that on the charts. That's why, hence, we're seeing those breakouts and those changes of dynamics of long-term downturns that are starting to move to the other side. And so, I'm not just an optimistic here. I'm trying to look at history and see, look, these things are very mispriced relative to what they could do. And in my view, the mining industry, there's some reasons why general investors have been avoiding the mining industry. We could get into that too. But, in my view, we're poised to see some big changes in fundamentals that can drive the capital back into this industry.
Yeah, and it seems like we're almost seeing these. I mean, we see new data and facts almost every day about what this new green revolution will happen when we start to transition our energy grids. It seems like, that's not going away on the commodity sector. But I'm curious, when you look at something like that, like where's the biggest opportunity right now? Pardon me. And why, Tavi? I mean, if it's not in gold, is it in copper?
Well, I love silver first and foremost. I think silver is if you're a believer that we're going to see a gold bull market and you want to take more risk and potentially higher reward, silver is, to my view, to go back to the levels that we saw in the prior highs and actually a breakout from those levels and go much further out than people even believe. And that's because of its place in the world today in the global economy as solar panels. I mean, solar panels used to make up, single digits of the supply of silver. And now it's actually, getting a lot closer to actually double digits, but much higher levels. I mean, it's been growing exponentially in terms of just that alone. But what people forget is the monetary aspect of silver itself when gold starts moving. And I think that that's coming too. And so I know my main focus has been in primary assets that have silver as a production to begin with. Zinc is another one that I think it also offers an incredible opportunity. If you look at the zinc price, it's been an upper channel for a long history. We're talking centuries. And now we're actually at the bottom of that channel right now, and a lot of people are very bearish about that in the metal. And I do think that we're probably going to go a lot higher. I love copper. Copper is sort of the obvious metal that we should all be focused on for electrification reasons. But certainly, some other opportunities where that, I think Senzel said this phrase that I love. Great money is made where capital, lacks interest. And I think that the mining industry, gold and silver, are certainly probably in the forefront of those opportunities today. And so, of course, there's going to be other metals and businesses that have their own uniqueness in terms of attractiveness to invest. But I think that the big macro trend to me still is on silver, and in terms of the big potential to the upside that you ask for. So to me, that would be my favorite metal.
Great. And you look at some of these companies, and to be honest, some of the CFOs, not all, we do know that mining can have some interesting bad apples too, but some of them have been just doing really, really well with their sheets, trying not to increase their G&A costs, kind of keeping it down. Talk to me a little bit about any quarters that you're watching on the release side. I want to tease it before I let you go. Is there anything that we should be watching for in terms of these metal prices starting to hit balance sheets?
Look, I guess it's related to your question, and I think it's a great way to kind of explain the opportunity today, and also what I'm looking forward to in terms of deploying capital right now. I looked at a mining, project privately, let's say, or if sometimes public investments too, but even in a private side, it's even more interesting because of the prices. Lack of liquidity allows you to find even better opportunities. What you find in those businesses, I'm talking about producing asset, and you look at what they estimate in terms of free cash flow, in terms of how much they're going to earn versus how much they're going to spend. Basically, that comes down to metal prices and their estimates of potential, not even cost to produce that commodity, but also the macro outlook in terms of inflation. And the assumptions that are being made today in those businesses, and the way they're being priced so low, and the main reason why they're being priced so low is because most of those companies are selling these assets and with the idea that we're going to see massive inflation on cost and deflation on metal prices. I don't know anybody who can support that view here. And so, in my opinion, if one is likely to be pricing assets in that way today, in an overly conservative way, there's a reason why, if you're a general investor and you're not really in the trenches of knowing that what is the estimates of gold prices. Some of these companies are doing 1,800 gold prices still. You look at the price sensitivity of their resource models, are still running 1,600 gold prices. We are not there. We're in a different environment. But if you're going to price that as an investor, I love it. Now, if you're a general investor just watching what's likely, Newmont, Barrick, all these companies to make in the future, and you're just looking at the big dogs and saying, well, here's the estimates that they're providing us of what they're likely to be making, you're going to be shocked. You're going to be like, they're not going to make any money. Why would I even invest in this? I get it. It's because you haven't done your homework. You haven't gone deeper enough to understand that that's because on the back of their estimates and assumptions that either the industry is forcing them to do so, or they're just being overly conservative because, they have to be. And so it is interesting to me as a, if I look at that, for instance, as an example relative to technology companies, you see the opposite. You see revenues surging and costs, plunging. And that's usually what you tend to see during, places where everyone is putting the capital into this sector of the economy and things are so frothy. That's the opposite of the mining industry. And so that's to me why in the next decade or so, it wouldn't surprise me if we see major changes in estimates and actual earnings of most of these companies. And they're probably going to be, in my view, swimming in cash by the end of this decade.
Yeah, well said. And I mean, even if the retail audience isn't watching, that there's a lot of CEOs right now running numbers not at these levels, trying to find some M&A targets and finding these assets at these, I guess, affordable costs, huh?
Yeah, I mean, we've had a small change in prices recently, and mining companies had a run. Some of them were really low prices. They had a 30-40% run up, and guess what? It just unleashed all these, this sort of M&A news that we haven't heard in a long time. Imagine on the back of a gold market that desperately needs metals. I mean, all these companies desperately need to increase their reserves. And if we see that, I think that could be the biggest, M&A cycle we're probably going to see in this industry. And so when I look at prior cycles, I'm like looking, I think it's going to be 2x that, because, the problems are way worse. I mean, the capital constraints in this industry and the demand that is likely to come from this. Think about, the folks that can understand the copper side and where most of the demand will probably come from. Think about the gold space then. If we're going to go back to a world where central banks are going to accumulate back to, from 20% of their balance sheet back to 70% of the balance sheet owning gold, boy, we need a lot of gold here. We're talking, tens trillions of dollars here that needs to be added to. I mean, this is a huge market. So this to me is yet to be turned as well.
Yeah, well said. Tavi Costa, partner and macro strategist at Crescat Capital, joining us today from Colorado. Always a pleasure, Tavi. I could have got into that way more, but we'll have you on when we see what these gold prices do.
Thanks for having me. I appreciate always the interview.
Of course. Thanks, Tavi. Appreciate you. I'm Jeremy Szafron. For all of us here at Kitco News, thanks again for tuning in. Lots to get to this week, so hit that notification button and stay tuned.